Hey everybody, thanks for joining in. It's been quite some time since we've all gotten together and discussed Windmill Capital small cases. We were supposed to do it last month itself, right after rebalance, but then there was the festival season, and we thought it's better to sort of push it a little so that more people can join in and we are able to have a fruitful discussion. So let's get started. Today, the topic that we are discussing is going to be about momentum investing. You know, how momentum works as a factor. What has been the general performance of momentum factor over a period of time? What is the best way to invest in momentum stocks? And uh, the recent performance of some of Windmill Capital's momentum small cases. So let's get started. You've all been following cricket. There's been the recent Asia Cup, and then subsequently, there's the women's World Cup going on. And one of the things that everybody talks about in cricket is you're always backing an informed player, right? Suppose there is the next star who has not played a lot of cricket versus an informed player that you have to pick for today's match, then it is always very easy to back an informed player instead of trying to figure out who is going to even though somebody might have a lot of potential. um, it is better to go in with the informed player who has some amount of experience than picking up the instar player and giving him a chance. So that is generally what momentum investing is all about and how it operates in the stock market. So before we actually jump into momentum investing, let's take a step back and let's try to understand what is factor investing. You've all heard about you've all heard about Warren Buffett and how he goes out and picks up companies which have a very very low PE, and it's not just a question of having low PE. One of the other things that Warren Buffett always talks about is how these companies should have a strong moat. Their fundamentals have to be very good, and all of these things. Essentially, what he's looking for is a bargain, and he hopes by picking up companies for a bargain, he will be able to make extraordinary returns over the long term. So this uh, school of thought is usually called value investing. So what is the value? What is the factor over here? It is value. It is the value factor that is expected to drive the stock prices and give extraordinary returns to the investor over a period of time. So very similarly, just like value, there are other factors also. There is the growth factor, investing in growing companies, fast growing companies. There is the quality factor, investing in high quality companies. There is the question of investing in low volatility companies. Momentum companies, that is companies whose stock prices have been witnessing momentum, and you expect that the stock prices will continue to rise, and you go ahead and invest in such companies. And then there are dividend paying stocks that a lot of people would prefer to invest in. And so these are all the various factors that are available to us in the market, right? Generally, when I say market, there could be other factors that asset managers talk about also, but generally, if you sort of look at academic literature and generally accepted factors, these are usually the six. And there is also a question of investing in, there's also the size factor, that is a trend of investing in small cap stocks, hoping that they will grow to become large cap ones and investors can earn extraordinary returns on them. So out of all of these 6 to 7 factors that are available to us, today we are going to concentrate on momentum factor. So let's understand how momentum investing works. So as I told you, the general idea behind momentum investing is you are picking up stocks that have already started witnessing some strength or who have already been raising, and you invest in them expecting that they will continue to raise further. So the first point is you're trying to ride the trend. You're not trying to predict which one is going to do well. So you're not trying to, momentum focuses on joining the stock once it shows strength. Extremely important. You're not trying to pick a stock at its bottom. You're not trying to exit it at its top. What you're doing is you're checking to see where there is a strength, where there is a certain trend, and instead of doing any sort of prediction, you're joining in the trend. That's all momentum investing is all about. So moving on from riding the trend or sort of building on that, you have middle of the trend capture. I'll show you a case study also. Middle of the trend capture. So what you're trying to do is there's been a lot of studies that shows that most of the returns occur after the initial move but before the peak. So you might have a stock moving in from, let's assume the stock is trading at 20. You might have the stock moving in from 20 to 30, 30 to 40. And this is when most of the people start noticing that, there's this upward movement that has started happening. So more people are going to join in. And within a quick time, the stock jumps up from 20 to 30, 30 to 40. If it had taken, let's say, 2 months time, from 40 to 80, then to 160, then to 240, and so on and so forth, it's going to raise up within a much shorter time. And this is what, momentum investors are trying to sort of capture. This very quick upward movement is what they're trying to capture, and that is what is called as the investing sweet spot. So third factor that is extremely important here is crowd behavior, right? Usually when it comes to investing, we are always talking about how one should not follow the crowd, one should not follow the herd, one should use their own, brains when it comes to investing and all of these things. But with momentum investing, you're doing the exact opposite thing. Here, you are checking to see what is the collective, behavior of investors as far as particular stock is concerned, and then you're sort of trying to leverage on that particular behavior. So crowd behavior matters over here. Last important, very important, a lot of people confuse momentum investing with timing. This is simply not a question of timing. What you're trying to do over here is you're regularly monitoring your stocks or your universe, right? You are checking to see where the trend has started moving up. You are going to invest in that particular stock. You're going to regularly monitor your portfolio. And once where you feel that the momentum has sort of slackened or the pace has sort of started coming down, you are going to exit your stock over there. So there is no attempt to time the market. There is no extreme emotional reactions over here. What is there to momentum investing is regular monitoring, applying the appropriate or correct filters, rebalancing in order to manage your risk, and then exiting without worrying about any other short-term noise or getting into stories behind the stock. Okay, this is how momentum investing works. Now, I'll give you an actual example of what has how momentum investing worked for us when it came to Exide Industries. We had included Exide Industries because it was witnessing momentum and it was available at a slightly low valuation. It was part of multiple small cases, and this is how it has actually worked for us. So you can see that between July 2022 and July 2024, for almost 2 years, momentum factor shot up from 100 to 400. That is, if you had invested 100 rupees within a short span of 2 years, you would have ended up quadrupling your investment. And that is when we started seeing, or that is when we started noticing. So if you can see, the momentum sort of started in July 2022, and we sort of caught on to that strength in April 2023. So there was a full 6 to 7 months time period when the stock price started raising, but it was sort of range bound between 100 and 150. And in April, the momentum sort of started strengthening, and that is when we invested in the stock, right? And you can see what sort of happened to that subsequently. Between April to July, that is close to 11, a little over a year's time period, it went up from 150 till close to 450, right? And then we were not immediately able to detect the fall or the slackening of the trend. We held on to it for 6 more months, and by Jan 2025 we exited. Jan 2025 rebalance, we exited the stock. So perfectly, if you had managed to time the market, which nobody can actually do, you would have invested somewhere in July 2022, and you would have exited at sometime in July 2024, and you would have made 4 times or a little more than that of your returns. But we don't live in that fairy tale world where you're able to perfectly time the market. What we have access to is pretty robust filters and rebalancing and all of these things. So because of our robust filters, we were able to sort of join the trend a little after the bottom in July 2022. We were also not able to sort of exit it exactly at the top. We had to give up a little bit of our gains. But what happened is in Jan 2025, we managed to exit the investment. So a couple of takeaways. We joined the trend after the initial strength. We certainly missed the bottom, but we were able to capture a lot of the upward movement. And this is a practical example of why you're sort of not attempting to buy low and sell high, but you're trying a more disciplined approach where you are checking to see what is the strength in the movement, in the upward movement, and you're trying to capture that strength, or you're trying to be part of that upward journey. Okay, this is how momentum investing actually work, and this is how it has worked for one of our stocks, Exide Industries. Now, there are a lot of facts and myths about momentum investing. Let's jump into that. Momentum always wins. Certainly not. There can be a lot of times where momentum can lag. Sometimes it is like very, very systematic. It is sort of like, the journey that we've been going through over the last 1 year. We've actually seen that when compared to the broader market, momentum as a factor has performed very, very poorly. I'm going to share some numbers with you. Momentum always wins is certainly not true. Second myth, it is too risky and works only in bull markets. Anybody who's invested in our small cases, you will be able to see that it may not be able to outperform across markets in every single market, but a lot of times what happens is momentum factors tend to be flattish in bearish markets and tend to work very, very well in bullish markets. So it will outperform across market cycles, and it will generally tend to rotate in and out of strong sectors and stocks. So it is sort of a very good bet to take. You must buy low and sell high. Certainly not. I have already showed this to you. It aims to capture the middle part of the trend, and you're not really trying to time the market into buying at the low and selling at the high. It is only for short-term trading. Anybody who's been investing in our momentum small cases like Value and Momentum, GemQ, and all of these things, know that that is certainly not the case. Exide Industry is a classic example. It was not a short-term trading that we did. We held on to that stock for close to 639 days in a specific small case. So that's more than a year's time. And even with a lot of our momentum small cases, you can see that it is quarterly rebalancing, and we are not trying to move in and out of positions in a very, very short time frame. The next point is that momentum usually tends to ignore fundamentals. That is certainly not the case. Momentum often reflects improving fundamentals and investor sentiment. Once again, I'll go back to the Exide stories. It is not without reason that Exide Industries had started doing its upward journey. There was a lot of news coming out about how the general market sentiment had started improving for two-wheelers and four-wheelers, and Exide of course makes a lot of it derives a lot of its revenue by supplying batteries to two and four-wheeler OEMs. So that was one of the factors that was driving up the price of the stock. And there was also this additional news that they were moving into the electric vehicle manufacturing or electric vehicle battery area, and they had come out with promises that they're going to be making huge amount of investments in setting up factories. So these are some of the fundamental factors that were driving up the price of the stock, and which is what we try to capture. So the question of ignoring fundamentals and just like that a stock price is running up, no, that usually does not happen. So the last thing is too many people use it, and that's why momentum investing does not work. Once again, I'll share some more numbers with you. In fact, there's a lot of academic research to suggest that over the last 200 years, this is one of the few factors that has consistently worked across geography, like across countries and across markets. 200 years worth of history. So, and this is of course because there's a lot of human behavior, crowd psychology, and all of these things involved. And that is why the momentum factor has been able to sustain itself. Now, the next and the most important question, very, very relevant when it comes to our investors as well, because a lot of people, what I have seen is they tend to invest in momentum small cases. They wait for a year's time, and they say if they don't see any returns, they would want to exit it. So this is actually some numbers that I have pulled up for you. This is Nifty 500 Momentum 50 Index versus Nifty 500. What we are trying to do with this particular chart over here is we are checking to see what is the possibility of underperforming Nifty 500. Now, Nifty 500, I'm taking it as a proxy for the broader market. I'm checking to see if you were investing in Nifty 500 and Nifty 500 Momentum 50, what is the possibility of sort of underperforming Nifty 500 depending on your holding period. Okay, so if your holding period was just 1 year, there's like a 29% possibility that you will underperform the market. If your holding period is 3 years, that possibility of underperforming Nifty 500 drops down to 3%. And if your holding period is 5 years, there's almost a 0% probability that you will underperform the broader market. So this chart, very, very important. Just because it is momentum investing, don't treat it like short-term trading. Don't come in with the idea that you're going to invest in that particular strategy for 1 year, you're going to make buttload of money, and then you're going to be able to move out of that particular strategy. That's certainly not the way it works. If you come in with very, very short-term horizon, I have actually shown you the data. If you look at momentum, working of momentum index between Jan 2013 and October 2025, so that's more than 12 years worth of data. If you come in with a very, very short-term, inclination to hold it for a very, very short term, there is like a significant probability that you will end up underperforming the market. So very important. Next one, what has actually happened to momentum as a factor? How has it performed when compared to all other factors or some of the other factors where data is available to us in the public domain, right? So between Jan 2013 and October 2025, more than 12 years, Nifty 500 has generated CAGR returns of 13.1%. And you can see that Nifty 500 Momentum 50 has been the best performer by a mile, right? Nobody has been able to get near it, and it has performed 20.2%. And this is the CAGR returns that I'm talking about. Once again, please keep this in mind. This is not 1 year return that we are talking about. This is not an average return. This is the CAGR return that we are talking about. So if you're investing in any momentum strategy, come in with the long-term idea. And over a period of time, the strategy is going to work very, very well for you. Okay. So that is the takeaway. Now, let's come to the recent performance of momentum factors. Let me present this chart to you. You can see that the thick black line over there is Nifty 500. And I have pulled up the chart between October 2024 till October 2025. Okay, the thick black line over here, this is Nifty 500. Nifty 500, and you can see that if you had invested 100 rupees in Nifty 500 1 year ago, that would have turned into 94.88, which means it's almost down by 5% over the last 1 year. Very similarly, that brown line over there is Nifty growth sector, Nifty small cap 100. If you had invested 100 rupees, it would have been down by 8%. Nifty, the green line, where it is down by almost 6%, is value factor, Nifty 500 value 50, and Nifty growth, it is down by 10%. If you had invested 100 rupees, you would have been down by about 10%, and your 100 rupees would have turned into 90 rupees. What is the worst performer? Nifty 500 Momentum 50, right? If you had invested 100 rupees, it would have dropped down to 80 rupees. You can see that, huge gap between the other factors and Nifty 500 Momentum 50, right? So there is always a scope for underperforming. We've already seen that there's within a 1 year time period, there is 29% possibility that your Nifty 500 Momentum 50 will underperform Nifty 500, and you can see it live. This is what has happened to the index over the last 1 year. Okay. Now, keeping all of these things as background, right? Where I have talked about how one should approach momentum investing, what is the probability that you will end up underperforming the market, what is the historical performance of momentum as a factor or as a strategy in India, and how it has performed over the last 1 year. Let's move on to performance of Windmill Capital's momentum small cases. So there are a couple of different small cases that I have pulled up for you. First one, value and momentum model small case. Now, one thing about Windmill Capital's momentum small cases is they're not just pure momentum strategies that we are presenting to you, right? We are presenting, or what we have done is we have packaged it in such a way that you are going to get exposure to couple of different factors. So starting with value and momentum, here you're getting exposure to value factor as well as momentum factor. Now, over the last 1 year, I'm going to start with the slowdown phase now. Over the last 1 year, the factor has been down by about 11%. Okay. And during the same time, equity multi-cap has been up slightly by about 4%. If you sort of look at the 1st October 2024 to 10th October 2025 dates, it's been up by about 4%. Equity large cap is also down, and equity small cap is also down. But this 11%, down 11%, it is if you look at historical performance since 28 March 2023 till 27 September 2024, which was like a growth phase for India growth story. There was a lot of things that were happening. If you sort of look at this underperformance, it is followed by 115% return. So anybody who had invested in on 28 March 2023 even if you were standing today, you would have still managed to double your investments as far as value and momentum model small case is concerned. Next one is GenQ model small case. Here you're getting exposure to growth, quality, and momentum. Three different factors. GenQ model has been flattish over the last 1 year, negative 0.3%. But during the growth phase, it had given 137% returns. So if you compare 28 March till 10th October, you would have generated about 135% returns or 136% returns, right? Quality small cap quant down about 10%. If you remember, overall, the small cap universe has also not been performing so well. You can see that here it is down about 6.2%. Quality small cap quant down about 9.25%, but it had generated 125%. One of the most recent new additions to the paid universe is the growth and value multi-cap model, where you get access to growth, value, and momentum. And that has been down about 13.5%, but it had generated 160% returns. So anybody who's invested over a long period of time, as far as these small cases is concerned, you can see that they would have all made extraordinary returns over the last 1 year. And during bull markets, you can see that all of these strategies have significantly beaten our multi-factor models, right? So this is the general performance been like, okay? So keep these factors in mind. Now, I just want to spend some time explaining to you how is it that our small cases have performed the way they have done. First aspect is and when I'm saying how they have performed the way they have done, I'm talking about significant outperformance during the bull market, and during the bear market they are either staying flat or they are modestly down, right? Okay, how is that happening? How is the fall not as steep as momentum is down 20%, but none of our small cases are down 20% is the question that we are trying to ask ourselves. First, we are taking a multi-factor approach, right? We are not giving ourselves exposure only to momentum, but it is either always usually value plus momentum or growth plus quality plus momentum or size plus quality plus momentum and so on and so forth, right? So by giving yourselves exposure to multi-factor models, what is happening? You're not dependent on the performance of one single factor within a short period of time. You're able to limit the damage to your portfolio. Second thing, of course, there is regular rebalancing, and when we are rebalancing, we are checking. There is a lot of safety filters that we are applying. We are checking for liquidity, we are checking for promoter pledges, default probabilities, any other red flags like ASM, GSM list, and all of these things. So where we feel there could be a potential for damage, all of these things are being removed, from the we are not even allowing such stocks to sort of get into the basket round. That is a very robust process that we have. A lot of these are proprietary that we have developed just for you guys. And the last one is, of course, rebalancing, right? We always trying to ensure that via rebalancing, we ensure that our constituents are aligned with the selection criteria. All our rebalancing is about maintaining discipline. There is absolutely no scope for making any emotional decisions just because the factor has started underperforming. We are not going to try to meddle around with it, because over the long term we know that the strategy is going to pick up and start performing well. So the question is never about reacting emotionally to market noise. It is not about predicting markets, certainly not, or chasing short-term returns or trying to sort of time the market. It is all about ensuring that the constituents are aligned with the selection criteria and maintaining that investment discipline. So key takeaways, the magic of momentum investing versus reality. Momentum is certainly not about magic. It won't always win, like we've been seeing over the last 1 year, or it will not predict perfect tops and bottoms like that it has happened with Exide Industries. So when does it work? It works when you sort of apply it systematically, when your filters are robust, when you're when you're rebalancing the portfolio regularly, and you're not allowing any emotions when it comes to your investing, right? Multi-factor approaches plus discipline. That is when momentum works best. It helps you capture the trends while also controlling risk. Okay. And the last one, the magic factor as far as momentum is concerned is really about human behavior. And when you're trying to sort of leverage on that human behavior, there has to be certain rules associated with that investing that you're bringing in. And it is when it is at a combination of these two, or it is at a integration of these two, that momentum investing works really, really well. So that sort of brings me to the end of my presentation. We can start taking some questions over here. Okay. First one, Pamna is asking, Nifty 500 Momentum 50 versus Nifty 500. Could you please explain it in in more simple terms? Sure. Let me just get back to that slide. So, okay. Here, what I have done is I have pulled out index series for Nifty 500 Momentum 50 index as well as Nifty 500 index. Okay. Then I calculate, 1 year holding returns, rolling returns for 1 year period, rolling returns for 3 year period, and rolling returns for 5 year period for both of these indices. Next, I check to see how many times, Nifty 500 manages to outperform Nifty 500 Momentum 50 manages to outperform Nifty 500. Okay. And then I calculate the numbers. And then what I can see is 29% of the times the momentum index underperforms Nifty 500 when the holding period is just 1 year. So if you're holding the index for just 1 year, there is a 29% probability that you will underperform the broader market. But hold on for 3 year period, that is compare the 3 year performance of momentum 50 versus Nifty 500, and possibility of underperformance drops down to 3%, right? And do the same thing on the 5% line, and it is almost 0%. There's almost no possibility that you will end up underperforming the broader market when it comes to investing, right? So I hope that understands that sort of explains it to you. She's again asking, why should we merge momentum with other factors if momentum alone gives good returns? Right. See, this will probably explain it to you. There's always a possibility that momentum over a period of time will give you good returns, but there's also momentum is also usually accompanied by high volatility, and you can see that over here, right? Over the last 1 year, momentum is down about 20%, whereas the other things are not down so much, right? So by combining your investment with other, combining momentum factor with other factors, what you're trying to do is you're trying to mitigate the downside risk for that particular small case, which is extremely important for anybody who's investing, right? You don't want to lose 20% of your investment. If you can get away by adopting some scientific techniques, if you can limit the downside, or if you can even get to a flat returns, which is what has happened in GEMQ model small case, you can see that you've gotten flat returns. It is certainly better than going down 10% or 15% or 20%, right? So that's why you sort of multi-factor approach is much better than uh, giving yourselves exposure to one single factor. Next, Anubhav is saying, is Windmill Capital momentum strategy want to reduce high drawdown, or that is not our focus, and we know momentum will come with high beta? So momentum tends to come with high beta, and our focus is always about reducing the drawdown, right? If you sort of look at the value and momentum model or GEMQ or anything of that sort and compare it with the comparable index, which usually is equity small cap or equity multi cap indices, over the long period of time, you will see that. I'm more than happy to share those numbers with you, Anubhav. You can mail it to mail in. You will see that the max drawdown is significantly lower for our small cases when compared to the broader market. Okay, so if you want those numbers, just go in and mail me at support@windmill.capital, and I'm more than happy to share those numbers. Do you have any plan for creating small case for Nifty 100 market cap? Rudra is asking. There are a lot of ETFs already available. No point in creating another small case for that. Momentum will work only if exits from stocks happen quickly. As soon as momentum is lost, then why we rebalance only after? Isn't that too slow? Anubhav, I don't know if you saw the entire presentation. Let me go back to the story of Exide Industries. You can see that, momentum started in July 2022. And even if you consider the top, it was there for almost 2 years. So I don't know. I've been telling this to people over and over again, and somehow the point does not seem to get through at all that, people confuse momentum investing with short-term trading. That is not the way it works. Both of them are very, very different things. And please don't believe this idea that you have to exit from stocks. If you had exit, you could have gotten at 100, and within 3 months you could have probably exited at, let's say, 140 or something of that sort. If you had done that, this assuming you could have captured that upside momentum from 100 to 450 or 400, close to 450, that would have been completely lost. So get this idea out of your head that momentum will work only if exits from stock happen quickly. That is not the truth at all. there is like a whole host of academic literature that talks about rebalancing once every 3 months or once every 12 months, and they are able to do very, very well. So uh, please get this idea out of your head that you should be rebalancing very quickly to capture the momentum and stuff like that moment. And this particular XID industries, we held on to it for about 639 days, right? That's the number, and we were able to generate close to 150% return. So there you go. Abu is asking me, can you tell us something about Alpha Prime Momentum model? Not a Windmill Capital small case, Abu. No idea about it. Just reach out to the investment manager, and I'm sure they're going to be able to, tell you more about that particular small case. Uh, so I think that's pretty much on the questions front. I hope you found the presentation interesting, and I was able to help you out with some of the facts and myths associated with momentum investing, and I was able to give you a little more clarity about why our momentum small cases have not performed as well over the last 1 year compared to their historical performance. Um, if you have any more questions, please feel free to mail in at support@windmill.capital. I'm more than happy to help you out with any questions or concerns or any doubts that you may have about your investments, right? So I think that was a good session. Let's stop here. Thanks a lot, everybody, for joining in.
Yes, Naveen, we can drop